Good afternoon and welcome back to the latest edition of the Invest Stock Market Analysis for the week ending July 25th, 2025. And this week I am titling the video Meme Stock Craze Marks a Sentiment Extreme. And this is, uh, I think, one of the first signs that the pendulum has shifted, right? You had peak panic back in April after the tariffs, and we've slowly crawled back, obviously, to new highs on the major indices, and more confidence has been infused in the markets as well as the liquidity. So there's definitely some liquidity dynamics here. Now we're in the midst of earnings season. So what you can see here, this is the S&P 500 heat map, and you can see there's a good amount of green, but there's also, based on earnings announcements, there's some red as well from the likes of IBM here down 8% of the week, Texas Instruments. We had, what's this one? Honeywell down 8%, Netflix down 5. What's this one? Analog Devices down pretty big. Tesla has obviously had a rough earnings announcement as well. So definitely some poor reactions, but some good reactions as well. You had Google had some good reaction on earnings. Some of the banks did continue to do fairly well. Some of the private equity did well. I think it was Blackstone. Yeah, I think Blackstone had pretty good earnings, et cetera. So, but some obviously not as well. You have Coinbase down 6% on the week. You had Apollo, that was actually down 3% of the week. So that was the one that the private equity side that didn't do so well. Capital One had earnings down a little bit. So, you know, uh, we continue to get a mixed bag out of earnings, but overall the trend is higher. And we'll talk a little bit about the meme stocks that kind of rallied, and oftentimes that does give you a sentiment extreme reading, and so we'll dig into that. But I want to get into the economic news first. You had Richmond Fed manufacturing that came in at -20, the lowest level since August of last year. So the on the at least Richmond Fed, it's not doing so hot. The Kansas City Fed that did much better. The manufacturing side still negative territory, but still kind of around that zero line, so not a whole lot of growth. Existing home sales did surprise to the downside, but we still remain kind of in the same level as we've been at for the last 2+ years. And frankly, this is kind of the low end of what you can expect. Like mortgage rates are continuing to push towards 7%. The housing market overall is becoming more balanced, but you still have a problem with affordability. There are definitely pockets of the country where there's year-over-year decreases in price. Now, it's typically not dramatic, low single digits, but it's definitely a change of character for the housing market. And so I don't expect home sales to really break down dramatically. This 4 million level is uh, is already in a challenged place. And so it would take a really, really bad economy, I think, for this to break below the 4 million level, but obviously not breaking out one way or the other. New single family homes sold. So that came in also near the low end of its recent range. I don't know why that did that, but you can see here, this is the range so it's been in for the past couple of years. So while there's a lot of talk about the housing markets and it getting weaker, from an activity standpoint, it's just where it's been. But as you have that low level of activity, you do have inventory rising, and that becomes a more balanced market. And that's kind of what we're in now. It's not necessarily a buyer's market, not really a seller's market nationwide. It's more balanced. Obviously, each individual region and sub housing market has its own dynamics. So some are still in the buyer's market, some are now flipped to a seller's market, but just generally, it's a bit more balanced. You did have the initial claims come in. Let me zoom into a 1-year chart so you can see how much this has dipped back down, right? We try to break out. We hit that 250 level back here in June. We've come all the way down. And you say, okay, well, everything's fine in the labor market. And at least for layoffs, that's kind of true. But when it comes to continuing claims, let's zoom back in here to the 1 year. And we saw this broke out after Liberation Day, hanging around the 1.85 million mark, heading up to the 1.95 million mark. So that's about 100,000 more people are on the unemployment since Liberation Day. Not extreme, it's a mild change in the housing market. But what you can see is, even though a lot of people aren't getting laid off, it's not changing this. You would think that, hey, people aren't getting laid off, the initial claims continues to drop, but that the initial claims continue to drop, but the continuing claims is just staying in this 1.95 mark. So maybe this is the new average for a little while, right? That 1.85 is in that range for a good year plus. So this is just a continuation of a weakening labor market, but not something that is breaking anything to a major degree. So something of note, and we'll get the non-farm payrolls on Friday of this upcoming week. So Friday is the first Friday of the month, and we'll get more color on the labor market for the month of July. Durable goods dipped down here. New orders dipped down, but still in an uptrend. So durable goods seems pretty fine. You do have the Fed credit, commercial bank credit, total credit. I talk about this. This is remaining in an uptrend, right? You want to see this in an uptrend. This means that there's more liquidity being created by these commercial banks. And as long as that's the case, that should support asset prices. Same with the Treasury General account. They did tick up recently, so that is pulling a tiny bit of liquidity out of the market, but it was pretty minor. You're talking about 296 to 323, so about $25 billion. Nothing extreme, but if they do start to refill this in earnest, that will certainly change the dynamics of liquidity in the market. But global liquidity still remains relatively robust. So nothing. I don't see an inflection point in liquidity in the shorter term, but that doesn't mean you can't have a modest pullback in markets, which I'll get to in a little bit. But I do expect that over the next couple of months. The Fed announcement is coming out this week. We know that the current administration is looking to replace Jerome Powell before May of next year. You had that kind of I don't know if it was a press conference or whatever you want to call it. It was definitely kind of looked like a World Wrestling show, type of thing with Jerome Powell, and he kind of pushed back on President Trump in real time. So that was interesting. But it's clear that he's trying to set something up to replace him. I think there's two things that they haven't come up with a replacement, and then the longer they wait, what's the point of really trying to push on this when there's only a handful of Fed meetings for the rest of until June, which would be when that next Fed president is going to take the head of the Fed. Now remember, this is a committee. This is not like the Federal Reserve Chairman has carte blanche. There are 12 members. There are 8 voting members, and so even if he replaces Jerome Powell, that doesn't mean that the committee is going to automatically cut rates. So I think that's another factor people are under appreciating, is that that's one person out of a 12-person committee. So, and it's coming up in May. Let's say you have this Fed meeting, which is done, right? You're not going to get a new Fed chairman through before this Fed meeting. Okay. So after that, you have 1, 2, 3 for the rest of the year, 4, 5, 6. So you have 6 more meetings effectively before a new Fed chairman is going to be in anyway. And you're going to probably get ahead of that 3, 6 months anyway, right? So as time goes on, I think it's more of a show. Probably doesn't really push Jerome Powell out, and the market is expecting a pause. They are looking at a cut for this upcoming quarter, upcoming meeting in September, the next Fed meeting, and obviously they'll signal that this week if they're going to do that. So that could be a catalyst. Maybe the Fed says, no, we're still not ready to cut rates, and obviously politically that would be challenging, but at the end of the day, the Fed's supposed to be unbiased and not push one way or the other. Inflation has not really improved recently. In fact, if by some measures has moved up a little bit, nothing dramatic. And what we're seeing is actually we should get inflation to slowly accelerate closer, a little bit above 3 by year end, versus now we're, depending on what gauge you're talking about, a little bit below 3, 2.5 in that range. And so doesn't really give a backdrop for the Fed to cut rates. You have asset prices near new highs. You have unemployment rate that's still uh, low. You have the labor market. Like I said, the continuing claims is showing some weakness, but it's minor. It's not anything that is drastic that probably warrants any major shift in viewing of the labor market. So I think the Fed is going to be on hold, and I think this could be a catalyst for that Fed to maybe not cut rates as well in September. So that's a summation of the economic news, what happened this week. But let's get into the charts here, and I'll start with some of the meme stocks, and this is what I titled the video. Here's Beyond Meat. These are businesses that just are not, they're not very good businesses. Most of these business, they don't make money, right? So you had that short squeeze. It has reversed rather quickly, which it always does with these money losing names. Same with Open Door, excuse me. There are people calling about this. I had a caller, I believe it was that a Monday or Tuesday? And I said, this looks like it topped here when it closed with this giant wick on volume, closing at the lower third of the candle. And, it really did opened higher, but then faded real quick. And, we definitely faded with some of these meme stocks by the end of the week. But usually when you get these really crappy names getting short covering rallies, this is kind of the end of it. It's when those worst names are the ones that are going up. There's no, you've squeezed out all the shorts. Nobody is betting against the market, and everyone's kind of in. Now, does that mean you can't go higher in markets in the short term? No, I think there's certainly potential for markets to do okay in the short term, week, 2 weeks, etc. But the more you get into August and September, which seasonally are the weakest times in the market, you get this overbought scenario in the S&P and just broader indices, and it means that there's probably a setback in markets at some point over the next, call it 8 to 10 weeks. Here is the semiconductors as well. So we know that semiconductors tend to lead the tech industry, and this has had kind of a bit of a rollover this week, right? So this was on Monday. You had this have a topping tail, a wick on pretty good volume here as well. But that breakdown on Tuesday, and then you just kind of micro consolidation for the rest of the week. And so, you look at some of the names within it, NVIDIA, kind of look at NVIDIA. This is making a divergent high here where you sold off, you rallied, but look at the MACD. It's already rolled over. This is at obviously a pretty big high here. Let's go to a weekly. Right, a divergent high as well. MACD is not matching this recent high, so I think there is an impetus here for potential breakdown. Intel obviously had a rough earnings announcement. AMD was strong, but if you look at what was the other one, I'm trying to remember. I showed you on the heat map. Which name was that? Let me pull that up here. It was one of these tech names. Where was tech? There we go. Text Instruments obviously down 15%, and there was ADI, there we go, analog devices. So anything analog related, that's what Texas Instruments is, as well as they tend to produce analog chips. So that rolled over. You had, let's look at Texas Instruments rolling over. So definitely some weakness out of the chip sector that could start to bring down the broader tech space. At least, and when I say bring down, I think broadly liquidity is good. So it's hard to see anything that is going to break the market in the short term. And the longer you get into the year when with the market up, the higher odds you continue with that uptrend at least until year end. And so my expectation is a modest pullback in markets that brings, think of the Qs. We had this gap here on the Qs. You get gap fill, right? Which would just bring you back down into this consolidation area before another move higher, probably into year end. And that is the most likely scenario in my mind. The market's kind of stretched, with sentiment stretch. Here's the NYSE. That's had a nice rally into some upper resistance here potentially over this next week. And that's what I'll be watching for. But nothing to be alarmed about, just saying, hey, if you think about putting money to work over the next month, there's probably some opportunity here. Now, the big question is, was the catalyst? And when you say that, that usually, you could say, oh, it's the tariffs, but the tariffs keep being pushed down the road. It's pretty clear the tariffs are going to come in at 15-ish to 20% range on average, which the market so far seems to be okay with, although it is pushing into some of the inflation data, but not in a major way. So just of something of note, the dollar as well. Does the dollar get a rally here? The dollar's been down a lot. You're starting to get, look at this MACD, you're starting to get some divergences here on the dollar that if this gets a rally, that would mean liquidity would tighten a little bit. And this is a big reason why markets are at new highs, because the dollar has weakened so much. Remember, the dollar is the denominator. What is the price per share, earnings per share, right? This is all dollar denominated. If the dollar's down, that boost the value of dollar-denominated assets like U.S. equities. And so just something of note there, if the dollar does get a rally, that would also precipitate most likely a modest pullback in markets. Let's take a look at gold. And this is another indicator to me that you could see the pullback is gold didn't really have a great week. It rallied a little bit Monday, Tuesday, and then sold off and closed slightly down on the week. And we've gone through this consolidation period. We probably need a break lower to get people offsides again, right? This is actually bullish consolidation. What I could easily see is some sort of catalyst, whether that's a dollar surge or whatever, that brings gold down into probably the 100-day moving average. Maybe you get all the way to 200. I probably doubt that, but do you get something that dips below the 100-day moving average, kind of like you got back here, right, to kind of scare people that it's going to break down, and then you get the rally from there. I think that's a pretty likely scenario at this point. But overall, the trend is higher in precious metals, and I expect that to continue to do well. Silver, that had broken out. Obviously, a rough day on Friday, and this is another sign that you might get a pullback in the precious metals, and that is oftentimes a signal of liquidity starting to inflect a little bit in the short term. So I wanted to highlight that. Let's go to the VIX. The VIX is very low. We're back down to 1493. So this is a lot of complacency, and the cost of insurance in the market is very cheap. And when that happens, that usually gives the what we call tinder for a market sell-off. When everyone's worried about the market dropping, the market won't drop. It's when people aren't worried about it anymore, and that meme stock rally is an indicator that not a lot of people are betting against the market or hedging against the market downturn, and suddenly you get some sort of catalyst, whether that's tariffs or something else, and then suddenly the market has room to move down, and then investors start to hedge, they start to sell positions, they start to position, they buy insurance on the market because volatility suddenly is going higher, and that kind of is self-fulfilling, and that's where you get that market sell-off and that kind of at least short-term panic, and so the dry tinder is there definitely for a market sell-off. Let's go to copper. Copper's been strong. The base metals, let me go to our natural resources. So this is strong. This is another area where I see a lot of opportunity. Look at this, had been in a long downturn, and it's just starting to enter in this uptrend. And look at the volume here on GNR. and it's pretty impressive. And frankly, I think especially with the new Fed, which will likely be some sort of they'll try to bend the knee at least to the administration. You definitely are going to get more money flowing into harder assets. So here, let's take a look at some of the names within this. So you have BHP, right? That's the top holding. You have ExxonMobil. Okay, that's the third largest holding. You had Nutrient, which is, I'm trying to remember the symbol on Nutrient. There we go, NTR. Okay, so these names are starting. This has been an uptrend for a while, but a lot of these names are starting to enter into an uptrend, and I really like this space overall. You had Newmont that had good earnings. That's the sixth largest holding here. Chevron is in this. You have Freeport McMoran, which is obviously copper that remains relatively strong. You have names like Reliance Steel. Let's see, RIGD. See if that wants to work. What is Reliance? Oh, that's RS, excuse me, Reliance Steel. Big drop here, but obviously still in an uptrend. So what you see is just generally harder assets are getting a bid. So I continue to like the natural resource space, the harder asset space, despite what I think there could be a modest dollar rally, and that would help with a pullback in markets. So something I'll be watching for. What else do I want to get to before we close it up? Credit markets. Another reason why I don't think any market pullback is going to be anything major, I just think it's going to be need to be a little reset of sentiment, is this. Credit markets are fine, right? Short-term junk, short-term treasuries, that's hanging in there. Even the CLO market. So here's the AAA CLO. So this is the subprime version of the housing market nonsense back in the late aughts, right? That brought down the credit markets. You're seeing that a lot with private equity, private debt, and that's what this is. This is the private debt market, and the Wall Street playing financial shenanigans in order to juice yields, et cetera. And this is where a lot of the risk is. So you saw why this kind of sold off. This is AAA. This is supposed to be very safe, but this sold off in a big way in March and April. But right now, everything's fine, right? This broke down in March and then continued all into April. You're not seeing that quite yet. So I don't really think that any pullback is going to be something you really have to worry about in a major way. As we levitate here, you continue have to be, you start to have to think about next year, right? It's hard to get a major market pullback, drop, with the backdrop that we're seeing in liquidity, in natural resource stocks going up, et cetera. I think volatility in the short term could go higher, but once again, it's probably at least a dip to be bought into year end. So that's about it. I hope that this video helped you get a grasp on kind of where the market is today and where it's likely headed. You can't get too bearish because the trend remains up and liquidity remains positive. So that's where we're at, and appreciate you all tuning in and liking and subscribing to this channel and our podcast Invest Talk. And reminder, the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell security or to participate in investment strategy. The views are my own and do not represent those of KP Financial or those associated. Have a wonderful weekend.